This is our gap video. Our indicator tracks gaps automatically. We must first, however, define what we mean by a gap. The gap is defined as the difference between the open of the current bar and the close of the previous bar. If the open of the current bar is higher than the close of the previous bar, you have a gap. Why is that significant? In an electronic market that has tremendous volume, really there should not be a gap, but sometimes there is. And when that occurs, we track it, we plot it. This is a 30-second bar. A 30-second bar should not have a gap between the open of the current bar and the close of the previous bar. If the open of the current bar is lower than the close of the previous bar, you have a gap. So now, if you have a gap that occurs as a result of the open being higher than the close of the previous bar, we expect a retracement back to that lower price. If it opens below the close of the previous bar, we expect a return back up to that price. Oftentimes these gaps get filled very, very quickly, and they're not particularly tradable. But on other occasions, they can be significant. So we keep track of the gaps on a separate chart. We can't predict them. We don't know when they're going to occur. But if we see that they have occurred, if the circumstances are right, it can become an effective way to take advantage of the trade and trade in the direction of the gap fill. Now here, for example, we have a more tradable condition. We have this lower gap here that is at 23.75. The market has moved up to 25.5. So with other indicators that show us that the market is turning, we would take advantage of that. Same here, the market is moving down, there's a gap. There could be any number of reasons why we're already trading short, but we definitely have an opportunity to take advantage of that little move and make a few ticks just from the gap fill. And here's a tradable upper gap. Of 1911.75 up to 13.25. That's not bad. Same over here. 14 up to 15.25. Now here we have an example of gaps that had existed for quite some time. When we get too far away from those gaps, we will tend to ignore them. But the closer we move toward them, the more probable the gap fill is going to be. So for example, at this dip, we might decide to go long with expectation that since we're in an uptrend, that those gaps will be filled. And as you can see, very easily that takes place. We've now changed over to a 15-second bar. 15-second bars will have more gaps than a 30-second bar, as you can see. So more trading opportunities will exist. You can shorten the length of the bar from 15 seconds to 5 seconds and go even to tick bars, and the same idea takes place. You're going to find gaps. Some of them are tradable, some of them are not. Now here we have the gap indicator tracking gaps on a 5-second chart. And as you can see, they do exist. And gaps are almost always filled. So just knowing that they're there can make a big difference. You need to have other indicators, of course, to know when to execute. But you have a high probability of the gap fill taking place because of the anomaly. And here's just a few more good examples of trading opportunities just using the gaps. So it works, it's there, they exist, and if you want to take advantage of some of the best tools to help you trade profitably, you come to us and we can show you how to do that. This is Rod Kusin and Spooman for Risk.